Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what's going on. I'm going to interject my financial opinions. We're going to go through some, how to get rich type stuff, and give some opinions around that as well. I don't know. I guess I just disagree with some people, or disagree with some of the statements that are being made. I'll give you my opinions on it, and we'll go through it together. So let's dive in. Let's take a look. Again, if you want to follow me, it's at finding_finance. And if you want to join the membership, it's finding-value.com. So this guy says, I believe most money problems come down to lifestyle expectation. You guys believe that? I'm having trouble figuring out how that actually comes about. It says, I believe most money problems come down to lifestyle expectations. I don't think that's the problem. I mean, I can have certain expectations for a lifestyle. I can come out, I can graduate, become an engineer, think that I'm going to be able to buy a house in 3 years, and it doesn't meet my expectation, right? But that doesn't mean I have a money problem. It doesn't mean that I go into debt. It doesn't mean that I do anything. Just because an expectation isn't met doesn't mean I have a problem. So I think that statement isn't a true statement. I think most money problems comes down not to lifestyle expectations, but probably because people maybe they don't understand the predicament that they may get into, or the problem they may get into by using debt unwisely. Maybe they don't understand debt. It doesn't mean that if something doesn't hit your lifestyle expectation that you actually have a money problem. Um, and money problems, I guess it could be defined differently. A problem is something that you can usually solve, and a problem is a situation that you get yourself into based off of money. So generally, there's a gap between spending and income. So it's not really a lifestyle expectation. It's probably the problem is not understanding how much you're spending in relationship to your income, perhaps, or they don't care. It says, in my 20s, I thought my bosses ran these precise, well thought out plans. Eventually, I saw behind the curtain. They were making it up as they went along. It was a liberating moment, realizing we're all idiots. I would completely agree with that. I actually used to think that my bosses were much better, much better put together. And when I saw what all the upper managers were doing, I was like, okay, these guys are all idiots, and totally agree with the statement here. Let's go through Peter Sutherland's thing here, his thread. It says, this thread will argue that a unique set of historical contingencies has obscured a looming problem for the oil market, one which has been delayed by unprecedented events and interventions but not negated. We believe that in 6 to 8 weeks, the market will be subject to extreme turmoil. That's pretty profound, guys. That's a pretty strong statement here. Now, I'm just reading this. I don't necessarily know if what he's saying is true, but let's keep going through it. He says, recency bias. One can hardly read an article on oil without being told of crude's supposed weakness since last June's highs, often accompanied by de rigueur chart crimes showing month after month of lower prices. These charts, of course, cherry pick a short-term price spike to make the case that demand has somehow collapsed. This is nonsense and ignores the extraordinary SPR maneuvers that were employed in the wake of Russia's invasion. Simply put, if 600,000 barrels per day were dumped from the SPR, oil prices should drop. And they did. Extra supply, 222 million barrels. Historic. But there's an elephant in the room. If demand were really that terrible, and you dump that much oil on the market, we know from March 2020 what happens. Price would get obliterated. That's not what has unfolded. $80 Brent is not consistent with a global recession. It never was. Oil would be much lower if the economy had truly crumbled, but it's not for a reason. Sigma, Sigma, Sigma. It says in March, when a rate-driven bank panic arrived, not quite, nihilo, but not widely predicted either. The pain for certain macro commodity HFs was swift. Over a 4-day span, successive 3 sigma rate moves forced production. So when he says sigma, that just means statistical probability. A 3 sigma move, it's a very low outcome or likelihood. 3 sigma rate moves force prominent oil market participants to dump financial length. If Rocos and Pierre A, e.g., are forced to unwind at once, the paper oil market will unwind with them. Negative gamma exacerbates the move in crude tanks. But one must ask, is a black swan rate event at odds of 50 million to 1 synonymous with macroeconomic meltdown? Not quite. That is, a forced deleveraging and reduction in VAR by commodity-specific shops does not by itself mean that the underlying commodity is doomed. OPEC plus, one of the most common misconceptions about oil relates to OPEC production cuts. Namely, the attendant time lag for cuts to hit EAI data. The physical oil market is slow moving. A tanker loaded in KSA, Saudi Arabia, will take 44 days to reach the Houston Ship Channel. Thus, cuts that start on May 1st will not impact data until mid-June. This leads inexperienced pundits to prematurely pronounce that the cuts aren't working or won't matter. These are amateur takes, and the key data to be watching is loadings. And the data confirms that the cuts are real and will print mid-June. Data, not guesswork. Mandatory SPR barrels. It says by the end of June, the most recent batch of planned SPR sales, 26 million barrels, will wind down just as the OPEC cut begins to print. Herein lies the problem. Macro oil tourists have dumped length and shorted certain categories at the exact wrong time. Children playing in the sand before the tidal wave hits come late June. Inventories will begin to draw at a rate that will force a Hobson's choice for the WH. Drain the SPR further, risking political blowback and burning powder in a non-election year, or sit idle by as the full extent of the crude's market imbalance emerges and oil spikes in second half. Neither is appealing for the administration, but we think the market will be allowed to run hot in the back half of 23. If it is, the likelihood of record high crude in the coming months is non-negligible. So this is China. Oil bears want the market to believe that Chinese demand is lackluster and will remain so indefinitely. This, frankly, is naive. We have already seen that Xi will risk losing face COVID-0 walkback to prop up the economy and keep people out of the streets. And while there are very real issues with China and its property market, and especially with respect to oil demand, and the needle is moving higher, not lower. In other words, it's spacious to suggest that China alone will be a material headwind to the point of suppressing global demand, especially in light of India. So India, the burgeoning population of the subcontinent paired with an insatiable demand for energy will help propel the current super cycle for oil that so many have already written off. Indeed, within a matter of months, the recent weakness for crude will be but a diesel haze in the Bohadale light. Delayed is not canceled. Rates are not oil. Demand is not weak. And the path for crude in the coming months will be sharply higher. You can bet against it, but you'll lose. Thanks for reading as always. Do your own due diligence. So that's Peter's opinions around it. My opinions are the same. Granted, I didn't have as much insight as him with the cutbacks and how long it takes for those cutbacks to hit the markets in America. So, yeah, I'm staying long oil. We'll see what happens. And that's his opinions around it. Key events this week, we've got retail sales data on Tuesday, housing starts data Wednesday, jobless claims on Thursday, existing home sales Thursday, 14 Fed speakers, including Powell, retail companies report earnings. Here is commercial and industrial loans just had one of their worst 2-month contractions in history. The only 3 other times we've experienced a similar problem was during the last 3 economic recessions. While the annual growth of business loans remains positive, it's crucial to emphasize the short-term changes given the developments of the recent banking crisis. At a time when corporate fundamentals are weakening and the risk of a recession is looming, financial institutions are being compelled to tighten their lending conditions. Let us not forget that the yield curve has been warning us all along. In November, more than 70% of the entire Treasury curve inverted, which is a signal that has never failed in forecasting severe economic downturns. So this is the commercial industrial loans, 2-month change, and we are negative. That does correspond with the 2000s pullback, the 08-09 problem, 2019 and 2020 crash, and we're starting to go negative. So that will impact the markets, and we could see a recession in the markets at some point in the very near future. So that is a possibility. And I'm opening up to that recession that is possible here at any point. So here's another one, how to get rich without getting lucky. I'll go into that a different time, but I do want to go in and touch that. Now, here's this guy. He says the biggest expenses offer the biggest savings. He's got the house, the car, the healthcare, and food, and all the way down into coffee. It says you won't get rich by making your own coffee. I don't even drink coffee, guys. It's not because of the cost. It's because I don't want caffeine in my body. That's what it is. Now, looking at this, I actually agree with his outlook. One of the things that I did, this was back in the mid 2010s or whatever, is I bought a house. And what I saw was that I could lock in my housing costs at a very low level. So one of the things I wanted to do is I could focus on growing my wealth by investing and growing my income and doing all that stuff. Another way that you can grow your income, I'll say income that can be invested, is you can lock in your costs. You can reduce your costs, lock in your costs, work on what is costing you money, what is drawing money out of your account. And a house draws a lot of money out of your account, or rent. I had rent, and my rent, I think back then was like $1,600 a month for a 2-bedroom apartment back in the day. And what I did is I bought a house, and buying that house, basically I had about a little bit more cost than renting that apartment to buy the house. I then refinanced later at a very low level. And now my cost of the house is very low. Yes, I do have taxes. Yes, I have insurance. I have all that stuff. But it's far cheaper than what I would have to do to rent a house, because my family's too big. I cannot go into a 2-bedroom apartment back in the early 2010s. And right now, renting a house is about 3 times the cost. It's about 2.5 times. 2.5 times the cost it is to own the house I own right now. So that has been a huge tailwind for me to make more money, is locking in my housing costs. I have no costs for my car in terms of paying something off. I own all my cars. They're all older cars. They're cheap, and I do all the maintenance on it. And that is basically, in a year, I probably have a few $100s in costs, oil changes, and I do all my own oil changes. I do everything, but it's pretty cheap. Maybe a wheel bearing here and there, some suspension work, some brake pads, whatever it is. I have done major car work as well, changing clutches, doing transmissions, doing all that stuff. I've done that as well. Healthcare costs, yeah, that's kicking my butt. My kids, they were premature kids, and they do have some breathing issues that I do have to pay for, which is kicking my butt to some degree. And then food costs. My costs right now, my car is basically nothing. And my largest costs are actually food, because my food costs more than my house. And healthcare costs creep up depending on the time of year. If my kids get sick and they have breathing problems, and you have to go to the emergency room because they can't breathe or something in the middle of the night, that can be very expensive. But right now, that's what's really kicking my butt are some of those. So here it says, during the last 3 rate cut cycles, gold has risen 200%, 170%, and 73%. I wrote about it this weekend. The link is on my profile. This is the TYX to TNX ratio that I talk about. It's uninverting. So he's basically saying the same things as I did, and why I loaded up on gold and some of the gold and silver mining companies because of this reason. I think that this is coming into strength here, and we could eventually roll back over. Now, we could be a little bit early too, and a lot of the times at the tops of these things, you get a spike in uranium, a spike in oil, a spike in all these things. So a lot of these, this is the downward movement in right here in the early 2000s. This is the upward movement in the late 2000s. And a lot of the spikes occurred at this flat period. Uranium ended its spike. Oil spiked in this general vicinity as well. And I think that it could still happen where we get a spike or something like that. But we could also stop and then roll over eventually. Gold does very well in those scenarios where we stop and start to roll over. I got Scotty here. It says, let's bust through next week. This is Sprott Physical Uranium Trust. We are right there ready to bust through. So we're real close, ready to break out. Hopefully we can get that breakout, guys. And that's what I've got for today. That's what I've got for today. So a little bit of a mix there, a little bit of opinions. And that's all I've got, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you haven't already, and we'll catch you guys next time. This is Finding Value.